Let's get more now on interest rates with Steve Leisman. Steve, the most recent Beige Book out a couple of hours ago, it showed some easing in supply disruptions, a little bit encouraging for inflation there. Fed funds futures, though, they're still pricing in a high terminal rate. What gives? What can we expect?
Yeah, you know how it goes, Sully. Seymour says it, and we make a chart on it, guys. If you have that Fed rate outlook chart there, we'll show you just exactly what Timmy was talking about. And you'll see that we're on that April contract, we're at 497 or kissing 5, if you want to call it. It means a good percentage of the market believes it's going to be 5. When that finally hits 5, will come on. It's 95.03 now on the price, which just equates to 497 on the yield. And you can see that the market thinks the Fed's got a bunch more work to do. That's 275 between here and 452 at least. And then I guess you dial in another 50 for the spring of next year. And then they think they're done and may go the other way, but increasingly less so when it comes to that January 24 contract. That's come up and up and up and up and closer to no change. And then, Sully, you say it. I got a chart on this, too. Take a look at the Beige Book. Supply disruptions are easing, relenting, and less severe were some of the words that were used along with it. Getting back to inflation, they say cost pass-through is more difficult than it was because of consumer pushback and some easing. Labor is still tight, but some hiring freezes. So remember the Beige Book, guys. You may not remember this, Brian. Maybe you do. March, January 21, they were pretty early in calling the supply disruption. So I was very interested to see that they were seeing some easing on some of that out there, and we'll want to see some follow-through next month to see if that's going to, A, be the reality in the economy, but also begin to color how the Fed thinks about supply disruptions and the associated inflation, sir.
I wonder, Steve, if the debate is turning. We had Ken Rogoff on the exchange today. I wonder if the debate is turning from, because there's kind of this, tell me if I'm wrong, there's like this expectation where once the Fed is done raising, it's going to start cutting. Rogoff's point today was pretty much, yeah, the Fed may stop raising, but they may not cut for years. What's sort of is there a consensus on this?
You know, if you told me you were going to talk about Rogoff, I would have brought the quote along, Brian, because I got it right here. I was looking exactly at it earlier today, and the quote is, I think that rates need to go to at least 5, but when they get to 5, it's still not going to be enough. We're in for stagflation, and that's a point they've started to look towards, and we're going to slow down at that point. And he talks about recession after that. But you know, Brian, it's interesting because I don't know which part of hike and hold people don't quite understand. The Fed has been very monolithic about this when it comes to what they're going to do. They're going to get up there and they're going to hang there until there is what they call sufficient evidence to bring it back down. I mean, it may be, John Williams told me a few months ago that it wouldn't be crazy to tweak on the edge once they got to their peak rate, maybe up a quarter, down a quarter, whatever. But ultimately, they're going to hold until they stamp out the fires of inflation.
There you go. Higher rates, 7.2% mortgage. You wonder what it means? Maybe not a lot around here, but for folks in Escanaba, Michigan, and Shreveport, Louisiana, and whatever else, it sure matters. Steve, thank you very much.